Hello, this video is the second video on capital structure. I hope you have watched my earlier video on Introduction to Capital Structure. Today, I'm going to continue with more detailed discussion on the Modigliani-Miller theorem, specifically on the proposition 1 and 2, under the assumption without corporate tax and with corporate tax. The examples in this video is taken from your prescribed textbook. Here is the textbook by David Hillier. I think it's very important for you to read the textbook to enhance the learning process and even try the exercises at the end of the chapter. I have rearranged, modified the content slightly as I hope to explain to you clearly. This topic is quite technical, with a lot of formula to calculate the value of firm, cost of equity, and weighted average cost of capital. I think the learning process will be effective with scaffolding, which means building a frame for yourself by organizing the material, by knowing when to apply which propositions of the theorem. So stay tuned and let's learn together. The first version of the Modigliani-Miller theorem was developed under the assumptions of perfectly efficient markets. The following are the three key assumptions: no taxes, no transaction costs, individuals and corporations borrow at the same rate. According to the proposition 1, the value of the firm is the same regardless of the financing choice in a world without corporate tax. Why? Argued that the size of the pie does not change no matter how shareholders and bondholders divide it. Managers cannot change the value of a firm by repackaging the firm's financing. The value of the levered firm is the same as the value of the unlevered firm. The debt-equity ratio would not affect the value of the firm. As shown in the figure, the value of the firm is a horizontal line for all levels of debt-equity ratio. Why? Through homemade leverage, individuals can either duplicate or undo the effects of corporate leverage. I'm going to explain the concept of homemade leverage in the subsequent slides. According to proposition 2, in a world with no taxes, the cost of equity is positively related to the debt-equity ratio. From the figure, the cost of equity, RS, is represented by the green line. The cost of equity is a linear function of the firm's debt-equity ratio. Why? The risk faced by the equity holders increases with leverage. Because levered equity has greater risk, it should have a greater expected return as compensation. According to proposition 2, in a world with no taxes, the weighted average cost of capital, WACC, remains constant despite the change in debt-equity ratio. From the figure, the WACC is represented by the red line. It is a horizontal line. The cost of debt, RB, is represented by the blue line. Even though the cost of debt appears to be lower than equity, argued that the firm's overall weighted average cost of capital cannot be reduced when the debt is substituted for equity. Why? The reason for this is, as the firm adds debt, the remaining equity becomes more risky. The increase in the cost of equity capital offsets the lower cost of debt. In the next few slides, I'm going to explain to you some important formula to calculate value of firm, cost of equity, and WACC under the propositions, assuming a world with no taxes. This formula shows you how to calculate value of firm. V stands for value of firm. The value of levered firm is the same as the value of unlevered firm. Value of firm is equal to value of debt plus value of equity. Value of firm can also be calculated as earning before interest and tax divided by cost of equity. What is the meaning behind this formula? Well, this is a perpetuity model whereby we discount the future cash flows assuming zero growth rate. The EBIT represents future cash flow. This formula is used to calculate the cost of equity. RS stands for cost of equity of levered firm. R0 stands for cost of equity of unlevered firm. The required return on equity is a linear function of the firm's debt-equity ratio. If you observe further, you will notice that the equation represents the equation of a straight line. The higher the leverage, the higher the cost of equity. This formula is used to calculate the weighted average cost of capital. B plus S is the total market value of the firm. If you notice from the formula, the weight of equity is multiplied by the cost of equity, and the weight of debt is multiplied by the cost of debt. Adding the two parts together will give us the weighted average cost of capital. Next, we are going to apply what we have learned from the propositions in an example. This example on Star Incorporated is adapted from your prescribed textbook, Corporate Finance by David Hillier. The brief background of the example is provided in this slide. I would encourage you to read the details in the example from the textbook. You are strongly encouraged to refer to the original textbook for further reading. To guide your learning, I have provided here with an empty frame for all the information that you need to calculate. You can make use of the formula that I have listed for you in the earlier slides. The green column is meant for the firm without any debt financing and 100% equity financing. The blue column is for the firm after conversion into 60% equity financing and 40% debt financing. Let's give a pause to this video and try on your own first. Fill in as much information as you can. I believe in this way you can learn better. Happy trying! When Star Corporation is 100% financed by equity, the market value of equity is equal to 140,000, which is 2,000 shares multiplied by share price of £70. As there is no debt, the total market value of the firm is also 140,000. Assuming a world without corporate tax, the earning after tax is 16,000. The return on equity is earning after tax divided by market value of equity and is equal to 11.43%. The value of equity can also be calculated by discounting the future cash flows, as represented by earning after tax divided by the expected or required rate of return of 11.43%. The value of the firm is equal to the value of equity, as the company is 100% financed by equity. As there is no debt in the company, the weighted average cost of capital is equal to the cost of equity. When the company changed its capital structure to 40% debt
and 60% equity, the fund raised from debt issue is 56,000. The fund is used to buy back some shares. Assuming the share price remains at £70, the number of shares outstanding reduces to 1,200. The proceeds from debt issue, 56,000, is used to buy back 800 shares at £70. The market value of equity reduces to 84,000. The total market value of the firm remains unchanged. This means the size of the pie is the same as contended by Proposition 1. Assuming no change to business operation, earning before interest and tax remains the same at 16,000. However, the company needs to pay interest expense, 8% on the debt. Earnings before tax reduces to 11,520. Assuming a world without corporate tax, the return on equity is earning after tax divided by market value of equity. The ROE has increased to 13.71%. The value of equity can also be obtained by discounting the firm's future cash flow, which is the earning after tax divided by the expected or required rate of return of 13.71%. The weighted average cost of capital is calculated based on 40% cost of debt and 60% cost of equity. The weighted average cost of capital remains unchanged after the debt issue.
You can also use the formula in the Proposition 1 and 2 to calculate the value of levered firm, cost of equity, and weighted average cost of capital. The answers can be reconciled with what you have calculated from income statement and discounted cash flow valuation. This slide shows a summary of the position of Star Incorporated when the company is unlevered and levered in a world without taxes. Let's check the data that we have calculated with the propositions. According to Proposition 1, value of firm remains unchanged whether the firm is unlevered or levered. According to Proposition 2, cost of equity is higher for levered firm and WACC is constant. I hope you have gained some insights from this example. According to Proposition 1, in a world without tax, through homemade leverage, individuals can either duplicate or undo the effects of corporate leverage. This means leverage does not affect the value of the firm. What is homemade leverage then? We are going to learn further. Homemade leverage can be defined as the use of personal borrowing of investors to change the amount of financial leverage of the firm by borrowing or investing. Homemade leverage is used by individual investors to artificially adjust the leverage of a company. Individuals can use homemade leverage to recreate or undo the effects of corporate leverage. There are three key assumptions about homemade leverage. Let's go through them one by one. Let's take a look into an example on homemade leverage. We shall refer to the same example, the Star Incorporated.
Investors can buy shares in an unlevered firm and borrows on personal account. In this case, investor is creating leverage. Assuming that the investor can borrow at 8%, the same term as the company, investor buys 60 shares with his own fund and borrow to buy 40 shares. The amount borrowed is share price of £70 times 40 shares. The number of shares owned by the investor is 100 shares. At the end of the year, investor will receive dividend per share of £8 from the unlevered firm. The interest paid on borrowing is 224, based on interest rate of 8%. The total cash flow received is £576, net of borrowing costs. The value of the investor's own equity is 60 shares times share price of £70 and is equal to 4,200. The rate of return enjoyed by the investor is the net cash flow divided by the value of his own equity. Take note that the investor has converted the expected return from an unlevered firm of 11.43% to 13.71%, which is the expected return of an unlevered firm. Next, we are going to explore how investor can undo the leverage from a levered firm. Assuming the original number of shares owned by the investor is 100, if the investor is not happy with the leverage position of the company, he can sell 40% of the shares. He sells 40 shares at share price of £70 and receives 2,800. The proceeds from the sale of shares is invested at a rate of return of 8%. The number of shares owned by the investor is 60 shares. At the end of the year, he will receive dividend per share of £9.6 from the levered firm. He also received interest from his investment at 8%. The total cash flow received by the investor is the summation of both the cash flows. The value of the investor holding is the value of the stock plus investment. The rate of return enjoyed by the investor is the net cash flow received divided by the value of his holding. Take note that the investor has converted the expected rate of return of a levered firm of 13.71% to 11.43%, which is the rate of return of an unlevered firm. Unlevered firm has lower return due to lower risk. Before I end this presentation, I would like to reiterate the summary of Propositions 1 and 2 in a world with no taxes. Here is the summary. And finally, here is a summary of the formula that we have learned for Propositions 1 and 2 in a world with no taxes. Finally, we have come to the end of this video. I hope you have benefited from the presentation and content in this video. If you like this video, please click like, subscribe or share. Thank you, see you and goodbye.